Welcome back, everybody, to another deep dive. Today's deep dive, we're looking at gold equities. I know this is a topic that a lot of you guys have requested, and I got to say, it's pretty fascinating what we found in the research.
Yeah, absolutely. A lot going on. I think we're at a pretty interesting potential turning point for precious metals.
Yeah, it's interesting because gold has been on this tear lately.
Hmm.
Some experts are even projecting prices to reach, get this, $2,600 to $3,000 by 2025.
Wow.
We're talking, Goldman Sachs, JP Morgan, some pretty serious players. But here's the thing that really got me. Okay, gold equities aren't exactly mirroring that surge. Like the VanEck Gold Miners Index is lagging pretty significantly behind. That just seems kind of counterintuitive.
Yeah, it's a curious disconnect. And to
Hmm.
understand it, we need to look at who's been buying all that gold.
Okay.
And it's not necessarily the investors who would typically drive those gold equity prices. You see central banks globally, they're scooping up gold at a rate we haven't seen in decades.
So you're saying there's a fundamental difference between how central banks view gold versus maybe your individual investor.
Precisely. And, a couple of really prominent voices in the gold world, they've actually been pointing this out. Adrian Day, for example, he highlighted in a recent interview that central banks are motivated by factors like, diversifying reserves and hedging against geopolitical risks. Whereas, like you said, individual investors, particularly in the West, they're still pretty hesitant about gold equities.
Yeah, it's interesting you say that because I was reading an interview with Rick Rule, and he was echoing some of those same sentiments. He actually talked about how a lot of Western investors, they really got burned in the last gold surge,
Hmm.
back in the 2000s. And that experience is making them really cautious, even with gold performing so well right now.
Yeah, makes a lot of sense. That skepticism that stems from that past underperformance is creating a really fascinating dynamic in the market.
Okay, so we've got this massive gold buying spree, but it's being driven by central banks, and Western investors are still kind of on the sidelines. They're wary of gold equities.
Hmm.
So what's the bigger picture here? What's fueling this central bank gold grab? Is it just about a safe haven play, or is there something, I don't know, a little more profound at work here?
Yeah, there's definitely a sense that this goes beyond just, looking for a safe haven. We're seeing a trend that some analysts are calling de-dollarization.
De-dollarization.
Okay.
Okay, that sounds pretty significant. What does that mean exactly?
So essentially, it's this move away from the US dollar as like the dominant currency in global finance. And this is happening for a couple of different reasons, right? So, like the weaponization of the dollar through sanctions, what happened with Russia, for
Oh,
example,
oh,
that's made other countries pretty nervous.
sure.
They're looking for ways to not be so dependent on the US dollar and on the US financial system in general.
So the freezing of those Russian assets was kind of a wake-up call for a lot of these countries.
Absolutely, yeah.
It highlighted that risk of relying too heavily on any style currency, especially one that can be used as, a political tool.
Right.
And so this has really kind of sparked a search for alternatives, right? Ways to diversify reserves and conduct trade in other currencies. And this is where gold fits in perfectly.
It's neutral.
Exactly. Yeah. It's
Yeah.
universally trusted.
Right.
It has intrinsic value, and it's not tied to any single country's policies. And so in a world that's becoming increasingly multipolar,
Right.
gold offers a sense of stability and security. We're even seeing the emergence of things like gold-backed bonds, digital tokens that are tied to gold. And there are even discussions about, partial gold pegs for currencies. These are all signs that gold's role in the global financial system, it's evolving.
It does feel like we're witnessing the early stages of a potential power shift in global finance,
Yeah.
with gold kind of right at the center.
Yeah.
Now, shifting gears a bit, let's talk about the U.S. specifically. Yeah. The research paints a pretty concerning picture when it comes to U.S. debt. Some experts are even saying it's reached, like, dangerous levels, calling it a debt time bomb even.
Yeah. The U.S. debt situation is definitely a cause for concern. I mean, the sheer scale of the debt is staggering.
It is.
It's gotten to the point where more and more debt is needed to generate even minimal economic growth. And this is all happening against a backdrop of rising interest rates, which only makes the problem more acute.
Yeah, it's a vicious cycle,
Yeah.
almost like this financial house of cards. And some of the research I was looking at drew parallels to the 1940s,
Oh, wow.
when similar debt issues led the Federal Reserve to implement this thing called yield curve control. I don't know if you're familiar with that.
Yeah, yield curve control, that's a pretty drastic measure. Essentially, what it involves is the central bank kind of manipulating interest rates, right, to keep them artificially low, which helps manage that debt burden. But, as we saw back then, it often comes at the cost of inflation.
So trying to control interest rates like that could actually fuel inflation, making the problem even worse.
Exactly.
And then if things really spiral out of control, wouldn't the Fed be forced to monetize the debt, as they say?
That's the fear. Monetizing the debt basically means printing money to buy government bonds. It's a last resort, but it can lead to hyperinflation and further devalue the dollar. And, if that scenario were to unfold, it could be a major catalyst for gold.
So we've got de-dollarization, this looming debt crisis in the U.S., and the potential for, runaway inflation. It sounds like a perfect storm is brewing, one that could push gold right into the spotlight.
It certainly has all the ingredients for a significant gold bull market. And that brings us back to gold equities.
Yeah.
The question is, will Western investors finally see the writing on the wall? And will they embrace gold equities as a way to ride this potential wave?
Well, that's what we're here to unpack, right?
Yeah.
And, you mentioned earlier that our listener is particularly interested in junior gold equities. So can you tell us more about the potential there? How do they fit into this bigger picture?
Yeah, so junior gold equities, they're often considered the venture capital of the gold world. They offer the potential for enormous gains, especially in a rising gold price environment. But, like any venture capital investment, they come with higher risk. So to really understand the opportunity, it helps to look at the life cycle of a junior mining company. And there's actually this great visual tool called the Lassonde curve that illustrates this journey.
The Lassonde curve. Okay, I've heard that term before. Can you kind of break it down for our listener? What does it actually tell us about the junior mining space?
Absolutely.
Yeah.
Absolutely. So the Lassonde curve, it basically maps out the various stages a junior mining company goes through, from initial exploration all the way to becoming, a producing mine.
Right.
It highlights the risks and rewards at each stage. But, most importantly, it kind of pinpoints those key buying opportunities.
Okay, so let's say our listeners is intrigued by this potential, right? What are those key buying opportunities, and how can they even identify them?
So there's kind of two sweet spots on the Lassonde curve.
Okay,
The first one is before or during a major discovery. This is when excitement really starts to build and stock prices often rise pretty sharply.
got it.
The second sweet spot is during those final stages of mine construction, right before production begins.
Okay.
At that point, a company is on the cusp of transforming from, like a story stock into a cash flowing operation.
So it's about timing the investment to coincide with those key inflection points in a company's development. But finding those sweet spots, that must require a lot of research, a lot of due diligence.
Absolutely. You can't just jump into any junior mining stock blindly. You need to carefully evaluate the company's management team, the quality of their projects, and their overall financial health.
So what are the key criteria that our listeners should be looking for when they're actually evaluating, a junior gold company? What separates, the wheat from the chaff in this space?
That's a crucial question. And I think, the first thing to look at is the management team.
Oh, okay.
You want to see a track record of success in the mining industry,
Right.
specifically in developing and operating mines, people who have actually taken projects from exploration to production.
So proven track record.
Right.
Yeah.
It's not just theoretical expertise. We're looking for practical
I'm
experience.
doing it.
Right.
Really.
What else?
Absolutely. Next, you need to assess the quality of the projects themselves. Focus on companies with large, high-potential deposits. These are the assets that attract major investment and have the best chance of becoming profitable mines.
Yeah.
Remember, in mining, size matters. It's like
Right.
real estate. Location, location, location. In mining, it's scale, scale, scale.
Exactly.
Okay. But even with a great team, a promising project, there's still the financial side to consider. How can our listener kind of gauge the financial health of a junior gold company?
Yeah, and that's where understanding a company's economics at current metal prices is crucial.
Okay.
Don't fall into the trap of relying on, future price increases to justify an investment.
Right.
Look for companies that can generate strong cash flow today based on where gold is currently trading.
Right.
That gives you a margin of safety and ensures that, even if prices stay flat or even pull back a bit, your investment has a solid foundation.
It's a good point. Don't get swept up in the hype of what the price might be. Look at what it is and can they make money?
Exactly.
Sounds like a pretty rigorous evaluation process.
It is, but it's necessary given the inherent risks in this sector. Remember, we're dealing with junior companies.
Right.
They're often exploring new territories, developing unproven deposits, and facing challenges that, more established miners don't.
Sure.
So due diligence is absolutely paramount.
Okay, so due diligence, very important. But let's bring this back to the macro environment we were discussing earlier. We
Mm.
talked about de-dollarization, the U.S. debt woes, the potential for inflation. How do these factors impact the junior gold space specifically?
So those are the forces that can make junior gold equities incredibly attractive right now. If those predictions of, $2,600 and $3,000 gold, if those come true, driven by the factors we've outlined, junior miners, they stand to benefit enormously. Their costs are often fixed, so as the gold price rises, their profit margins, they expand exponentially.
So there's almost like a leverage built in. The higher the gold price climbs, the more profitable these junior miners become, and theoretically, the more their share price should appreciate.
Right.
But how does that translate to actual investment decisions? How does our listener put all this knowledge into practice?
So there's a lot of information out there. It can definitely be overwhelming. But, resources like the Junior Mining Network, they're invaluable.
Okay.
They provide comprehensive data on junior mining companies, news releases, financial statements, project updates, all that good stuff. You can actually use their website to filter companies based on specific criteria, jurisdiction, market cap, deposit type, and more.
So it's like a specialized search engine for the junior mining world. You can really narrow down the universe of companies to a more manageable list.
Exactly. And then you can delve deeper into each company's profile, scrutinize their management team, analyze their financials, and really get a feel for the potential of their projects.
So it sounds like it's a combination of big picture, macro analysis, and then very granular company-specific due diligence. Not for the faint of heart.
It does require effort.
Yeah.
But that's the nature of investing in this space. The rewards can be substantial, but you need to be prepared to put in the work.
All right, so let's shift gears for a moment and talk about risk mitigation. We've highlighted the high-risk nature of junior gold equities. What are some strategies that our listener can use to kind of protect their capital in this, often volatile sector?
So one of the most important strategies is diversification. Don't put all your eggs in one basket.
Right.
Spread your investments across a portfolio of carefully selected companies. Ideally, 10 to 20.
So we're not talking about betting it all on one promising company. We're talking about building a diversified portfolio that kind of mitigates the risk.
Precisely. Diversify across geographies, deposit types, and stages of development.
Okay.
That helps to reduce your exposure if, one or two companies face challenges.
Don't put all your faith in one mine, one management team.
Okay.
But even with a diversified portfolio, things can still go wrong, right? What else can our listener do?
Position sizing is crucial. No matter how promising a company seems, never invest more than a small percentage of your overall portfolio into any single stock. Start with a range of 1 to 5%.
So even if you're incredibly bullish on a company, you're still limiting your exposure to a manageable level.
Exactly. Yeah. And this helps you ride out that volatility that's inherent in the junior mining space. Things can change quickly, unexpected delays, fluctuating metal prices, management missteps. Position sizing acts as a buffer, protects your capital from, catastrophic losses.
So diversification, position sizing, key risk management tools. But let's get back to the opportunity side for a minute. Are there any specific companies or themes within the junior gold space that are particularly compelling right now?
There are always interesting developments in this sector. One area that's been garnering a lot of attention is silver.
Okay, silver.
Historically, silver tends to outperform gold in a bull market,
Right.
and we're seeing some, exciting opportunities emerge in the junior silver space.
Silver, the poor man's gold, as they say. But it sounds like it could be anything but poor in the right market conditions. Can you give us an example of, a junior silver company that's kind of caught your eye?
One company that stands out is Avino Silver and Gold Mines. They have a solid track record of producing silver and gold in Mexico.
Okay.
Their recent production results have been impressive, significant increases in mill throughput and silver equivalent production. They're well positioned to capitalize on rising metal prices.
So they're an established producer, they've got a history of delivering results, and they're operating in a jurisdiction that's, relatively stable. That checks a lot of boxes. Any others?
Another one worth mentioning is Heliostar Metals.
Okay.
They're exploring for gold and silver in Mexico and Alaska,
Okay.
and they've been hitting some, very promising drill results. Their focus is on high-grade deposits, which is attractive from an economic standpoint. And, they have the financial resources to really advance their projects.
So we've got a producing company and an exploration company. Two different stages of development, offering different risk-reward profiles. Are there any broader themes or trends that investors should kind of be aware of?
One trend that's worth noting is the increasing interest in gold royalty and streaming companies. So these companies, they provide financing to mining companies in exchange for a share of future production or revenue.
So they're like specialized investors in the mining industry,
hmm
providing capital while also sharing in the upside potential.
Yeah, that's a great way to put it. And the beauty of this model is that it offers investors leverage to rising metal prices, but without the operational risks associated with actually running a mine.
It's almost like having your cake and eating it too. Exposure to the gold market without the headaches of mine development and production.
Right.
But they're still subject to the ups and downs of the market, right?
Of course, yeah. Royalty and streaming companies are still affected by market volatility and the performance of the underlying mining companies they invest in. But, for investors seeking to diversify their gold exposure and potentially reduce their risk profile, they can be a really valuable addition to a portfolio.
So it's all about tailoring your approach to your individual risk tolerance and investment goals. This has been incredibly helpful, and I'm sure our listeners are starting to feel a lot more confident about, navigating the junior gold space. Any final thoughts or advice before we wrap up this section of our deep dive?
The key takeaway here is that the junior gold equity space offers incredible potential, especially in a macro environment that seems, increasingly favorable to precious metals. But it's crucial to approach the sector with caution and a commitment to diligent research. Remember, knowledge is your most valuable asset in this market.
Well said. And with that, let's move on to the final part of our deep dive, where we'll delve deeper into the strategies and tools investors can use to make informed decisions in the junior gold space. Okay, so we've gone through, a lot of the macro trends that are driving gold, the nuts and bolts of really evaluating these junior mining companies. Now let's talk strategy. Are listeners ready to start exploring some of these investment opportunities in the junior gold space? Where do they even begin? It can be overwhelming, right?
It can be, but it doesn't have to be. The key is to really approach it systematically. First, remember the importance of aligning your investment strategy with your personal risk tolerance, your financial goals.
So before even looking at a company, you need to kind of define your own investment parameters.
Exactly.
What kind of risk am I comfortable with?
Exactly. What are your return expectations? What's your time horizon? All of that.
Right.
Once you have a clear understanding of your own, investor profile, you can start to narrow down that universe of junior gold companies to those that fit your criteria.
Now, we talked about resources like the Junior Mining Network. Are there any other tools or strategies that can kind of help with this process?
Absolutely. So one approach is to really focus on, specific themes or trends within the junior mining sector. For example, if you're particularly bullish on silver, you might focus on companies with, significant silver exposure.
Right. We talked about the potential for silver to outperform gold in a bull market.
Exactly.
So if you believe that scenario is likely to play out, focusing on those silver miners could be a way to really kind of amplify those returns.
Precisely. Or if you're concerned about geopolitical risk, you might focus on companies that are operating in, politically stable jurisdictions.
So kind of matching your investment thesis with some specific themes can help you identify those companies that really align with your overall outlook on the market. It's
Exactly.
about being strategic.
Absolutely. Another valuable strategy is to really follow industry analysts and experts who specialize in the junior mining space. They often provide insights and recommendations that can really help you identify, promising companies.
So it's like having a guide in this world. Someone's already done a lot of the legwork and filtered through a lot of the noise.
Exactly. But remember, it's crucial to do your own due diligence, even when following expert advice.
Of course, right.
Don't rely solely on someone else's opinion. Dig into the company's financials, research their management team, understand the specifics of their projects.
Become an informed investor. Don't just blindly follow someone.
Exactly. And another really powerful tool is technical analysis. This involves studying charts and price patterns to identify trends and potential buying or selling opportunities.
So technical analysis can kind of give you insights into market sentiment and maybe help you time your entry and exit points a little bit better.
Exactly. It's a way to gauge the supply and demand dynamics of a particular stock and potentially anticipate, future price movements.
But you shouldn't use technical analysis in isolation, should you?
Correct. It's most effective when it's combined with fundamental analysis. So understanding the company's underlying business, its assets, its financial health.
So it's really a multifaceted approach. combining the macro insights, some thematic analysis, expert opinions, technical analysis, fundamental research, really build that comprehensive picture.
Exactly. And remember, investing in junior gold equities, it's a marathon, not a sprint.
Right.
It's about taking a long-term perspective, being patient, and really letting your investments play out.
It's not about chasing those quick profits, getting caught up in the night.
Exactly. It's about understanding the fundamentals, managing risk, and positioning yourself to really benefit from the potential growth of the gold market.
Well, with the macro environment looking increasingly favorable for gold, now could be a really good time to start exploring this.
Absolutely.
This has been an incredibly insightful deep dive. I think our listener is now well equipped to start navigating this world of junior gold equities.
My pleasure. And, remember, the keys to success in this market: knowledge, diligence, and a long-term perspective.
Well said. And to our listener, thank you so much for joining us on this deep dive. We hope you found it valuable. Until next time, happy investing.